ETFs are the single greatest wealth-building tool available to the average person in 2026. They are how ordinary people with ordinary incomes quietly build 6- and 7-figure portfolios without picking stocks, without paying financial advisors, and without spending more than 10 minutes a month on their investments. Over $11 trillion is currently sitting in ETFs globally. $11 trillion. That's more than the GDP of every country on Earth except the United States and China. But here's the problem. Most people buy ETFs without actually understanding what they own, what they're paying, or what mistakes they're making. They pick the first fund that sounds good, dump money in, and hope for the best. Some of those mistakes are costing them tens of thousands of dollars over their investing lifetime, and they don't even know it. I'm going to give you 12 things you absolutely need to know before you put a single dollar into an ETF. Some of these will save you money. Some will make you money. And number 8 is the one mistake I see more than any other that silently destroys returns. My name is Phil, and I break down investing strategies in a way that actually makes sense. No jargon, no fluff. Just the information you need to make smarter decisions with your money. If you want to understand ETFs better than 95% of people who own them, subscribe and hit that thumbs up, because these 12 things are what separate informed investors from people who are just guessing. Let's get into it. Number 1. An ETF is not a stock. It's a basket. Most beginners think buying an ETF is like buying a stock. It's not. An ETF, exchange-traded fund, is a single investment that holds dozens, hundreds, or even thousands of individual stocks or bonds inside it. When you buy one share of an S&P 500 ETF like VOO, you are instantly owning a tiny piece of 500 of the largest companies in America. Apple, Microsoft, Amazon, Google, Nvidia, all of them in a single purchase. This is why ETFs are so powerful for beginners. Instead of trying to figure out which individual stock will go up, you just buy the entire market. If the overall market goes up, you make money. And historically, the overall market has gone up about 10% per year on average over the last 100 years. You don't need to be right about any single company. You just need to be right about the economy growing over time, and it always has. Number 2. The expense ratio is the most important number you will ever look at when choosing an ETF. The expense ratio is the annual fee the fund charges you for managing the ETF. It's expressed as a percentage. A 0.03% expense ratio means you pay $3 per year for every $10,000 invested. A 1% expense ratio means you pay $100 per year on that same $10,000. That sounds like a small difference, but over time, it's devastating. If you invest $500 a month for 30 years at 10% returns, a 0.03% fee leaves you with $1,012,000. A 1% fee leaves you with $823,000. That's a $189,000 difference from a fee that looked like it was less than 1%. Always check the expense ratio. If it's above 0.2% for a basic index fund, you're overpaying. The best funds in the world charge between 0.03 and 0.1%.
Number 3. There are 2 types of ETFs, and one of them is almost always better. Index ETFs passively track a market index, like the S&P 500. They don't try to beat the market, they just match it. Active ETFs are managed by professionals who try to pick winners and beat the market. They charge higher fees for this service. Here's what decades of data show. Over any 15-year period, roughly 92% of actively managed funds fail to beat their benchmark index. 92%. That means the highly paid fund managers with teams of analysts and billions in resources lose to the simple strategy of just buying everything and holding it. And they charge you 5 to 10 times more in fees for the privilege of underperforming. For the vast majority of investors, a low-cost index ETF is the correct choice. It's not even close. Number 4. You really only need to know 3 ETFs to build a world-class portfolio. VTI is the Vanguard Total Stock Market ETF. It holds over 4,000 U.S. stocks at a 0.03% expense ratio. This gives you the entire American economy in one fund. VXUS is the Vanguard Total International Stock Market ETF. It holds over 8,000 stocks outside the U.S. at a 0.07% expense ratio. This gives you exposure to every other major economy on the planet. BND is the Vanguard Total Bond Market ETF. It holds over 11,000 bonds at a 0.03% expense ratio. A portfolio of 60% VTI, 30% VXUS, and 10% BND gives you diversified global exposure with a blended expense ratio of about 0.04%. That's $4 per year for every 10,000 invested. Warren Buffett himself has recommended a simple index fund strategy for the average investor. You don't need 20 funds, you need 3. Number 5. ETFs beat mutual funds in almost every way that matters. ETFs trade throughout the day like stocks. Mutual funds only trade once at market close. ETFs typically have lower expense ratios. Most index ETFs charge 0.03 to 0.1%, while equivalent mutual funds often charge 0.5 to 1% or more. ETFs are more tax efficient because of their unique creation and redemption mechanism that minimizes capital gains distributions. And ETFs have no minimum investment. You can buy a single share for $200 or $300, or even a fractional share for $1. The one advantage mutual funds have is automatic investment. Some brokerages let you set up automatic recurring purchases of mutual funds, but not ETFs. However, many brokerages now offer fractional share automatic investing for ETFs too, which eliminates this last advantage. If your brokerage offers automatic ETF investing, there is essentially zero reason to choose a mutual fund over an equivalent ETF. Those are the first 5 things, but things 6 through 12 are where most people make the expensive mistakes. Number 8 is the one I see constantly, and it's silently costing people thousands. Stay with me. Number 6. ETF dividends are real money and you need a plan for them. When the companies inside your ETF pay dividends, those dividends get passed through to you. For a fund like VTI, the dividend yield is roughly 1.3%. On a $100,000 portfolio, that's $1,300 per year showing up in your account as cash. If you're in the accumulation phase, building wealth, you should reinvest those dividends immediately. Most brokerages offer automatic dividend reinvestment, also called DRIP. Turn it on. Every dividend buys more shares, which generate more dividends, which buy more shares. Over 20 to 30 years, reinvested dividends can account for 30 to 50% of your total return. Letting them sit as cash is one of the quietest ways to lose money. Number 7. Where you hold your ETFs matters just as much as which ETFs you buy. Taxable brokerage accounts, Roth IRAs, and traditional 401ks all treat your investments differently. In a Roth IRA, all your gains and dividends are completely tax-free. In a traditional 401k, you get a tax deduction now but pay taxes when you withdraw. In a taxable account, you owe taxes on dividends every year and on capital gains when you sell. The smart move is to hold your most tax-inefficient investments, like bond ETFs, in tax-advantaged accounts. Hold your stock ETFs, which are already tax-efficient, in your taxable account. This is called asset location, and it can save you thousands of dollars per year in taxes that most investors never think about.
Number 8. This is the mistake I see more than any other, and it's the one that silently destroys returns. It's selling during a crash. It sounds obvious when you hear it. Of course you shouldn't sell low. Everyone knows that. But when the market drops 30% and your portfolio goes from $200,000 to $140,000 and every headline is screaming that the economy is collapsing, something happens in your brain that overrides logic. You panic, you sell to stop the bleeding, and you lock in losses that would have recovered in months or years. Here's the data. If you invested $10,000 in the S&P 500 in the year 2000 and held through the dot-com crash, the financial crisis, COVID, and every other dip, your money would be worth over $65,000 by 2025. But if you missed just the 10 best days in the market, your return gets cut in half. If you missed the 20 best days, your $10,000 barely grows at all. The best days in the market almost always happen right after the worst days. If you sell during the crash, you miss the recovery. This is why dollar-cost averaging and never selling is the most powerful strategy for ETF investors. Automate your purchases, don't check your portfolio during downturns, and never, ever sell because of fear. Number 9. Most people own more ETFs than they need, and their holdings overlap massively. If you own VOO, which tracks the S&P 500, and also own VTI, which tracks the total U.S. market, you essentially own the same thing twice. The S&P 500 makes up about 80% of VTI. You're not diversifying, you're doubling up and paying 2 expense ratios for nearly identical exposure. Before you buy any new ETF, check the overlap. There are free tools online that let you compare 2 ETFs and see what percentage of their holdings are the same. If the overlap is above 50%, you probably don't need both. A simpler portfolio isn't just easier to manage, it's usually better performing because you avoid redundancy and keep costs lower. Number 10. Thematic ETFs are usually marketing products, not investment products. Every year, the industry launches ETFs around whatever trend is hot. AI ETFs, clean energy ETFs, metaverse ETFs, cannabis ETFs, space exploration ETFs. They sound exciting, they have cool ticker symbols, and they almost always underperform a basic S&P 500 index fund. The reason is simple. By the time a trend is popular enough to launch an ETF around it, the stocks in that sector are already overvalued. You're buying the hype, not the opportunity. And these funds charge 3 to 5 times the expense ratio of a basic index fund. If you want exposure to AI or clean energy, you already have it through VTI. Those companies are already in the total market fund. You don't need a separate thematic ETF charging you 75 basis points to own the same stocks with a fancier name. Number 11. Time in the market beats timing the market every single time. The most common question I get is, should I invest now or wait for a dip? The data is crystal clear. If you invested $500 on the first of every month for the last 30 years, regardless of market conditions, you would have outperformed almost every strategy that tried to time the perfect entry point. Dollar-cost averaging works because it removes emotion from the equation. When the market drops, your $500 buys more shares. When it rises, you buy fewer. Over time, your average cost is lower than if you tried to guess. Set up automatic recurring purchases of your chosen ETFs and do not touch them. The discipline of consistency beats the intelligence of timing every time. Number 12. The single most expensive mistake in investing isn't picking the wrong ETF, it's waiting. Every year you delay costs you more than any bad fund choice ever could. If you invest $500 a month starting at age 25 at 10% average returns, you'll have $3.2 million by age 65. Start at 35 instead and you get $1.2 million. Same monthly investment, same returns, $2 million less because you waited 10 years. You don't need the perfect ETF. You don't need the perfect timing. You don't need to understand every detail. You need to open a brokerage account, buy a low-cost index ETF like VTI, set up automatic monthly investments, turn on dividend reinvestment, and then leave it alone for decades. That is the entire strategy. Everything else is noise. Let me tie this together. 12 things. ETFs are baskets, not stocks. Expense ratios will cost or save you a fortune. Index funds beat active funds 92% of the time. 3 funds is all you need. ETFs beat mutual funds. Reinvest your dividends. Use the right account for the right fund. Never sell during a crash. Check for overlap. Avoid thematic ETFs. Dollar cost average every month. And start now because time is worth more than anything. If you remember nothing else from this video, remember this: buy VTI, automate it, reinvest dividends, and don't touch it. That alone puts you ahead of 90% of investors. So tell me in the comments, which ETFs are you currently holding? Are you making any of the mistakes I just described? And if you want me to break down the exact portfolio allocation strategy for different ages and goals, tell me below. That's what's coming next if you want it. I'll see you in the next one.